Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. A little closer to the board today because we're going to do some drawing, and I got something for everybody, actually. So we're going to cover everything, 4 different ways to avoid or maybe reduce your taxable capital gains tax, right? Because it could be going higher here if old Joe Biden becomes the president. I don't care who wins. I'm not being political. I'm just saying, hey, man's got a plan to raise long-term capital gains taxes, so we'll cover that. I'll go through the first one. The first one's really easy, and that is to use retirement accounts, right? Some people are going to think, oh my gosh, it's going to be a crappy video, but hang with me. In an IRA, you have the ability to put away $6,000 or $7,000, right? So $6,000 if you're less than or under 50 years old, $7,000 if you're over the age of 50. And what that does is if you're saving money there or investing it in that account, provided that you need to or want to, well, obviously that's going to eliminate the capital gains tax. You're going to deal with a different tax down in the future, but you're lowering your tax rate as well. If you think Roth IRA, then we're going to cover something interesting here. Same thing. Right, you got 7,000 if you're over 50, 6,000 if you're under 50. The idea there is, of course, you're not using a taxable account. I buy the argument of using a taxable account for retirement savings right now. Tax rates are super favorable. I understand that, but we're going to have to be a little bit strategic. So number one was just really simple. Use an IRA, Roth 401k, your 401k at work if you want. You can contribute a lot more, of course. So that's number one. Number two is if you're going to use a brokerage account, shoot for long-term capital gains in that account. Be more active in your Roth, right? So a lot of people look at their brokerage account and they'll have like a M1 account, Robinhood account, or some sort of brokerage account, right? And they're doing their active trading in this account. Whereas I argue you might want to do it in the Roth, right? Because you're not paying taxes there. If you want to be active, if you don't believe in that or don't want to do it, that's fine. But a lot of people just open a brokerage account, get to trading, and then they find out, oh crap, I have short-term capital gains. Doesn't matter if you have a smaller account, but as you get a sizable account over here, you're really going to start to regret the short-term capital gains because short-term capital gains are taxed as income. It's just as if you went to work and you made some money, you're going to pay ordinary income taxes. Whereas long-term capital gains are a little bit different of a story here. They get a flat tax. The way this works basically, and I'll do this real briefly and we'll get into some more detailed stuff, but let's imagine you're married, filing jointly, right? And you make under $80,000. So $80,000 or less, you are not going to pay long-term capital gains. It's free. It's as if you had a Roth, but the Roth doesn't have an age restriction, right? So you want to shoot for long-term capital gains in the brokerage account if you can. That's a 0% tax rate there. Right? For now, that may change, but for now, that's what it is. If you make between $80,000 and $500,000, right? That's I know it's a big jump there, but that's what it is. You're going to pay a flat 15% tax. Now, a lot of people mistakenly leave comments in the videos and they say, but Dustin, that's double taxation. No, it's not double taxation. It's 15% on the profit. If you make a $1,000 profit, $150 goes to the government, assuming you're in this camp here, and then you get to keep the $850. That's basically how that works. Okay, anything over $500,000 in income, let's say you sold a business or you have a really sizable account, you're going to pay 20% flat tax. This 15% is likely better than your ordinary income tax rate. So my argument is use the brokerage account for long-term capital gains and use the Roth IRA for your active trading, things like that, if you want to be more active. Right? It's up to you. Okay, number 3, be super diverse when you invest. Don't just buy 5 stocks. There's no commissions anymore. You can buy all the stuff you want. There's fractional shares. We use fractional shares here. For example, our dividend fund, which we post on our website, it's our portfolio, is made up of currently 99 different stocks. Usually it's 100, but it's 99 at the moment. So by being diverse, that gives you opportunity for number 4, right? If you can't go to number 4 with this tip here if you're not diverse. Here's the idea. If you have a brokerage account and you're super diverse, got a lot of positions in there, you're building a portfolio versus looking at stocks, well, then what you can do is sell your losers and add to your winners, right? In other words, rebalancing, but sort of a hybrid rebalancing there. Wouldn't you want to do that, right? If you have 2 stocks and one's a winner, one's a loser, you're likely not going to sell that one stock. You'll say, I'll wait till it recovers. Then I'll sell it. Now you're going to get stuck. If you have 100 stocks, a little more to manage. You got to do a portfolio sort of mindset there. But if you have 11 stocks that aren't performing well, it's such a small position, you're going to say, forget it. Just sell those and move them on to my winners. Well, by doing that, you now have a capital loss, right? Potentially a capital loss. So this takes me back to an example I did for a customer a long time ago. This is number 4. Here, this is a thought, right? It's just an idea. It's by no means a strategy, and I guess I won't go into all of it. But let's assume you have a sizable brokerage account. So I'm going to put up here, this is your brokerage account. I can't write and talk, right? So that's your brokerage account. And let's pretend that you're going to pay your taxes. And this was 2 years ago as the customer I'm thinking of. And you're like, oh man, I could use some help in my tax return. Man, I owe some money here. I'd like to try to reduce that bill. Most advisors just say, hey, just put money in an IRA if you qualify, right? So then you think, all right, I'll go over here. I'll put money in a traditional IRA. And as long as I qualify, I'll take my deduction. It'll be fine. But let's take it a step further. If you're diverse in your brokerage account, and you don't own mutual funds or whatever, let's say you had one of our portfolios or a couple of them, and you've got 200 or 300 stocks inside of there, you have access to the cost basis, meaning we have the ability to sell just a couple different stocks inside of there. We don't have to sell the whole fund like a mutual fund would. So what could happen, I'll give you an example of this customer here. They wanted to get the full $3,000 capital gains write-off. So each year, if you're not familiar, if you are an individual, you can write off $3,000 in capital losses in your positions. Again, if you have 2 positions, you're not going to do this. But if you have a very diverse portfolio, you might consider this. So he said, I want to take $3,000 in capital losses. Dustin, how much would we have to sell in order for me to lock in $3,000 of capital losses? And I've shown this, how we calculated it before. The system that we use. So in this case, we had to sell off $10,000 just about in total assets in order to generate $3,000 in capital losses. Right? So on paper, in other words, we had to generate that. So $10,000 is what we had to do. So then he says, okay, great, I got the $3,000 there. That's good. I'll have that on my tax return. That'll help. Maybe it'll give me a little bit of something. He was happy with that. And I said, well, wait a minute. You got $10,000 here. We're not going to leave it in cash, right? We just sold it. What are we going to do? The rule is we can't reinvest it right away. You got to either wait or invest it in something different. So my thought was, and this applies across both accounts, by the way. My thought was, hey man, why don't you take $6,000 and contribute it to your IRA, right? And then we can reinvest the other $4,000 within the rules, so we didn't have the wash sale trigger. We can invest the other $4,000 in your brokerage account. On paper, you got a $3,000 loss. I hope you're with me. I know, I go sometimes, right? So on paper, we got a $3,000 loss. He gets a $6,000 contribution for that year in his IRA, which means, let's just assume 20%. That's another $1,200. I don't know exactly where he landed, but that's a credit for him of $1,200. So he's got on his taxes a loss of $3,000 on paper, and he's got a $1,200 bonus or credit for investing in his IRA. Now, as long as we don't reinvest in the same positions, he gets to keep the $3,000 loss. If we did, by the way, he could just add it to its cost basis, but he wanted the write-off, so sorry to go off topic. And then we've got an extra $1,200 because he made the contribution of the traditional IRA, and he fully qualified to get the full deduction there. And so now we've got $4,200 to be used. I'm no tax genius here, but that's better than nothing. If we would have just been like every other advisor and said, just put money in your IRA, it'll be fine. Where's the money come from? Can we take advantage of this here? So in other words, that's the moral of number 4. Number 1, really simple. Use retirement accounts if you can. And individual accounts are fine, but use them to reduce long-term capital gains by maybe splitting them up. Number 2, shoot for the long-term capital gains in the brokerage account if you can. Use the active sort of mindset for your retirement accounts if you can, particularly Roth IRAs. Number 3, be super diverse if you can, right? All of our portfolios are made up of lots of stocks. We don't pick mutual funds. We don't play that game. We build a portfolio. So if it's a brokerage account and you have a specific need that you want to work out here, I can quantify that down to the penny and help you out, which leads me to number 4. If it makes sense, and a lot of our customers do this, let's use the end of the year to not tax loss harvest is what a lot of people say. Tax loss harvesting is being more efficient than this. But to tax loss, lock in the losses you have and consider using some of that money for the IRA. Did I lose you? I feel like sometimes I just, I'm excited to share this stuff with you. If I lost you in some way, give me a hard time. That's fine. I could take the hard time there. I just appreciate you watching and paying attention. I hope that it sparks questions. I teach customers. Every week we do a class for customers, but I try to do it in a way where I leave it open-ended a little bit so you ask the question. If I just tell you to do something, you may not know what's going on. And you're like, I don't know. I guess I trust him, right? Let's learn. Let me try to teach you. So that's what I tried to do today. If I messed anything up, these things happen. We made a lot of videos. Anyways, enjoy the rest of your day. Thank you so much for watching, and we'll see you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.